Earlier this year, it was hard to miss the stories about China going on a buying spree for commodities. Take coal, for example. China imported a record 48 million tons in the first 6 months of this year. Well, now China plans to open idle domestic mines, adding tons of new supply. Barclays says with little need to buy coal outside of the country, coal prices may tumble. Here to talk more about the coal market and China's hunger for commodities is Bart Melek. He's global commodity strategist at BMO Capital Markets. So, Bart, what impact will China opening up or reopening up its idle mines, what impact will that have on the overall coal market?
Well, I think it certainly will bias prices downwards. If you recall, in the first 7 months of the year, coal imports into China were up some 148%. In fact, I think so far this year, their imports are 52% over last year's. So, you know, there can be no mistake about it. Their big import numbers have rallied prices, I think, quite considerably. We've seen met coal up 40% from the troughs. We've seen thermal coal up about 25%, and the Newcastle spot market prices are up some 25% or so to 74. So that's a very healthy number. We've seen the Chinese idle an awful lot of capacity. That's going to probably rise by 60% as some of the safety concerns that they've had earlier have been addressed, and as prices have moved higher.
So Bart, does that mean that prices are going to have to come down as China reopens some of those idled mines?
I think certainly the pressure will be downwards, though the good thing is the rest of the world is just picking up as this might be unfolding. So the restocking in China, I think, is going to peter out, less imports into the country. But, very fortunately, the West, and that's the United States and Europe, will likely start reopening idled steel capacity, and that means metallurgical coal, and that means energy use generally will be higher, and that, of course, means coal.
Are you seeing, Bart, real demand kind of ramp up, and I'm kind of exaggerating here, but increase for various commodities like we're talking about here? Are you really seeing signs of that because the economy is indeed improving?
Well, certainly, for the year, we're going to have negative growth for most commodities. But there are very definite signs, especially in China, where demand for everything from copper to aluminum to oil has been moving up. That country has put in $585 billion in the form of stimulus. That is certainly having a good impact. We're seeing fixed asset investment up well over 30% so far this year. We're seeing retail sales surge. We're seeing auto sales do very well. So there is real evidence showing that there are, considerable gains in demand. Now, some of those imports certainly have been stored and are used as inventories, but no one really puts in inventories for no reason. Those inventories are kept in anticipation of a turnaround in production.
Bart, what's the bigger picture here? And I mentioned in the introduction to you that earlier this year it felt like we couldn't go by a day without a story about China, kind of increasing its buying in terms of commodities overall, really expanding its exposure. Is it just kind of getting set up for longer, getting set up long term for when that strong growth really comes back here?
I think that certainly is the primary reason why they have increased their imports. Also, they've shut down a lot of production. As you recall, coal is just one of them, but certainly steel production earlier in the year and late last year was down, aluminum as well, and the local market in China for many commodities has experienced a local scarcity. Globally, there was a massive supply, but locally, there wasn't enough aluminum to go around, and that's certainly evidenced by the price differential between Shanghai aluminum prices and LME prices. So, coal is just one of those stories. Now that prices are better, much of that production is coming back, and, that could reverse the impetus to import and could bias prices lower.
All right, so we just got about a minute left here, Bart. So in terms of pricing for coal, are you anticipating, and we talked a little bit about pricing earlier, a really significant drop-off because of the moves by China, or not necessarily because global demand comes back into the equation?
I think there'll be some move, but downwards on the net, but will be offset by seemingly fairly decent conditions coming up from the rest of the world, especially the U.S. We do have a formal forecast, and our met coal and coal prices are higher next year, but certainly today's spot prices are over and above considerably what we have as our settlement prices.
All right, 20 seconds left here. So as an investment play for investors, Courtney, our reporter, talked about a lot of investors moving into commodity funds. 10 seconds, you think there's a play here still for investors?
I think probably sitting on the sidelines for the short run, but commodities remain, as far as I'm concerned, a very bullish story longer term. And I think, it's you got to go long for the long term. If that's, if you're long a term investor, then long you go.
All right, we got to run. Bart Melek, thank you so much. Global commodity strategist over at BMO Capital Markets.